Welcome to the Working Thesis. It is Friday, July 17th. I am Maya, and sitting across from me is Theo. This week, we watched the entire semiconductor trade break. But here is the most fascinating part of the carnage. All week long, the underlying demand for artificial intelligence kept proving to be completely, undeniably real. Yet the stocks fell apart anyway, until Friday morning when they finally started to claw their way back from the absolute lows.
That is exactly the puzzle we need to take apart today, Maya. We are not just looking at a normal technical pullback. I think the question hiding under the surface, under all this panic of people asking, is there a floor forming here, is actually much bigger. I believe the market just quietly reclassified semiconductors this week. For the entire first half of the year, they were treated as a secular growth story, an unstoppable upward curve. And this week, the market suddenly shifted its framing and decided, no, this is just a traditional cyclical story again. Is that reclassification right?
And the real argument we are all having, the one that will define portfolios for the next 2 years, is whether that sudden reclassification is actually correct. We are going to explore that deeply today because honestly, I keep going back and forth on this myself. We will look at the tape, we will look at the fundamentals, and we will try to separate the market story from what is actually true inside these companies.
Quick note, this is education and entertainment, not investment advice. Companies are examples. Never buy or sell calls. Do your own research. Let us start with where we landed at the Friday close. It was a heavy week, and the final bell did not offer much in the way of a rescue. The Dow closed down 0.77%. Sitting right about 52,146. The S&P 500 dropped 1.01%, landing at about 7,458.
And the pain was even sharper in the tech-heavy indices. The Nasdaq fell 1.4%, closing at about 25,520. Even the small caps felt the pressure, with the Russell 2000 down 0.42%.
But the number that really tells the story of the market psychology right now is the VIX. The volatility index spiked 12% just on Friday, closing at 18.77.
That means the VIX is up almost 25% for the whole week. We are now creeping right up toward that 20 to 22 zone. Historically, that is the band where normal market jitters start crossing over into systemic stress territory. It is not full panic yet, but the anxiety is absolutely palpable on the screens.
To understand Friday's anxiety, we have to trace the 5-act arc of this week because the semiconductor space took an absolute beating. The SOX ETF fell 10.24% for the week key. The SMH ETF dropped 8.92%. This was easily the worst week for the chip trade in a very long time. Down 30% off a double is still up 40% from the start of the year, but the speed of this descent is what has everyone on edge.
It really was a 5-act drama. It started on Monday in Korea. We saw early margin calls hit the memory stocks hard. That was the first tremor, the first sign that the leverage in the system was getting shaky.
Then came Act 2 in the middle of the week. We got that unexpectedly cool inflation data, and suddenly there was a massive relief rally. But it was a head fake. The rotation out of tech was so violent that the chip stocks could not hold their ground, even as the rest of the market celebrated the idea of rate cuts.
Act 3 was Thursday. Taiwan Semiconductor, TSMC, posted an absolute record quarter. The numbers were staggering. And you might be asking yourself, but TSMC just posted a record. Shouldn't that save the stock? You would certainly think so. But the stock got hit with a vicious sell the news reaction because their margin guide was just slightly conservative. And that brings us to the final acts on Friday, where the crash in Taiwan spread globally, washing over everything in its path before a late attempt to find a floor.
Let us look closer at that Friday washout. Taiwan's TAIEX fell about 6.5%. That is its largest single-day point decline on record. It is hard to overstate the psychological impact of seeing a whole national index crater like that. Local TSMC shares were down 7.3% overnight.
The contagion was immediate. Japan's Nikkei was off about 4% in response. When you see those numbers flashing red across Asia, it is easy to assume the bottom is falling out everywhere. But this is where we have to look for the countercurrents, the little anomalies that tell a different story.
Exactly. The hopeful countercurrent was SK Hynix. In the midst of all that regional panic, SK Hynix actually bounced about 4%. And when the US market opened, we saw domestic chip stocks take a hard hit initially, but then they started to claw back off their morning lows.
That was the first real sign all week that buyers were willing to step up and absorb the selling pressure. So, is a floor forming here? It is a strong likelihood based on that intraday price action, but let us practice some humility here. This is a likelihood game, and no one predicts the future. This is just one read on today's tape. We could easily see more testing next week.
While everyone was staring at the semiconductor crash, a completely different shock was playing out in the energy markets. WTI crude oil jumped 3.6% on Friday, closing at about 81.77.
That puts WTI up a massive 14.5% for the week. The drivers here are entirely geopolitical. We are seeing severe US-Iran escalation rhetoric combined with renewed, very credible threats to Red Sea shipping lanes.
Unsurprisingly, the energy sector was the sole bright spot on the board. The XLE ETF rose 1.16%, making it the day's only real winner. Meanwhile, gold caught a bid, rising 0.9% to close at about $4,023.
And look at the bond market. The 10-year Treasury yield actually eased to 4.54%. This is a crucial distinction. When oil and gold are up, but yields are falling, that is the classic signature of a geopolitical risk-off trade. Money is running to safety. If this were a fresh inflation shock, yields would be spiking right alongside oil. The market is pricing fear of conflict, not fear of the Fed.
All right, let us step back and look at the real debate underlying all of this price action. In the first half of the year, the market decided that semiconductors were now a perpetual growth industry. The story was that AI in data centers, followed by AI in factories, in cities, in cars, in robots, would require so many chips that the old boom and bust cycle was dead.
But this week, sentiment swung violently back to, it is just a cycle. And I want to point out the ultimate tell that this is a narrative swing rather than a change in facts. Think about how the market reacts to news. When the dominant story is secular growth, a company announcing a massive capex increase is viewed as incredibly bullish. It means demand is infinite.
But when the narrative swings to cyclical, that exact same capex increase and any news of a rival expanding capacity is suddenly viewed as a massive threat. It becomes proof of coming oversupply.
To understand this, let us walk through the classic memory cycle. Think of a farmer. When the price of corn hits a record high, our farmer does the logical thing. He plants as much corn as he possibly can, but his neighbor is looking at the same prices, so the neighbor plants corn too. In fact, every farmer in the county plants corn. They all feel brilliant in the spring.
But then autumn arrives. They all harvest at the exact same time. Suddenly, there is a massive glut of corn hitting the local market all at once, and the price absolutely crashes. The cure for high prices is high prices. That is the traditional memory semiconductor cycle in a nutshell.
So the honest question we have to ask ourselves tonight is, which story is actually true right now? Is AI a perpetual secular shift that breaks the old farmer cycle? Or is this just the biggest planting season we have ever seen, leading to an inevitable, crushing harvest? We genuinely do not know the answer. It may take 2 or 3 years for the market to find out, and that is exactly the point. This is our lens for looking at the problem, but it is not the definitive answer.
If we want to understand how that cycle is playing out, we have to look at the mechanics of the foundries themselves. There is a mechanism here that most people completely miss. Everyone talks about high bandwidth memory, or HBM, which is the specialized memory that feeds AI chips.
Right, but HBM is literally just stacked DRAM. And because it is stacked, it eats up a disproportionate amount of front-end wafer capacity. According to TrendForce's latest estimates, HBM will consume about 22% of total DRAM wafer input by the end of 2026, but it will only supply about 9% of the actual memory bits.
And that math gets even more extreme looking forward. TrendForce sees HBM taking up 30% of wafer capacity versus supplying just 13% of the bits by the end of 2027.
This is the crowding out effect in action. Real AI demand for HBM is eating the factory floor. That crowding out sent conventional DRAM contract prices soaring by 93 to 98% quarter over quarter in the first quarter of this year. Mobile memory was up 70 to 83%.
It got so extreme that Tim Cook actually referred to it as a 100-year flood for the supply chain. Apple even raised Mac and iPad prices on June 25th, explicitly citing the memory and storage shortages. So the chain of cause and effect is clear. HBM and server demand crowds out wafers, which lifts ordinary DRAM demand and pricing, and that cost eventually lands right in the price of your new phone and laptop.
This brings us to the intellectual centerpiece of the week, Micron. At Friday's close near $849, Micron looks absurdly, almost screamingly cheap on paper. It is trading at roughly 6 times forward earnings.
But here's the trap, and why you have to be so careful with traditional metrics in this sector. That E in the price-to-earnings ratio? That earnings number represents a cyclical peak. Micron's gross margin has expanded to about 84.9%, up from just 39% a year earlier.
Some of that margin expansion is absolutely the durable, structural economics of selling premium HBM, but a very big part of it is a conventional DRAM windfall. It is a scarcity premium created partly by HBM stealing those wafers we just talked about, which has left customers willing to pay almost any price just to secure ordinary memory supply.
If you were to value Micron on normalized mid-cycle earnings instead of these peak scarcity earnings, that 6 times multiple could quietly be 20, 30, or even 50 times earnings.
The honest way to think about it is this. Micron is really 2 different businesses forced to share one fab. You have a growth cyclical HBM half and a deeply traditional, still cyclical DDR and NAND half. One single PEE ratio cannot possibly capture that complexity. We are not making a call on the stock here. We are saying the simple number on your screen lies to you. And that is exactly why analyzing this sector is so hard.
Part of the fear hitting memory this week revolves around a specific company, CXMT. They are China's largest memory maker, and they are preparing for an IPO on the Shanghai Exchange to raise about $8.55 billion. They have quietly grown to become the world's 4th largest DRAM maker, holding roughly a 7.7% revenue share.
The narrative around CXMT is getting a bit distorted, so we need to be precise about what they are and what they are not. Today, they do not break the HBM bottleneck. They do not have scaled, leading-edge HBM production. They have a higher cost per bit because they are using older tools, and in the near term, all of their output is being fully absorbed by domestic Chinese demand. Global supply is still nowhere near enough.
But we have to look out to the horizon. What CXMT does do is restore a highly credible path back to conventional DRAM price pressure in 2027 and 2028. You combine their new capacity with the big 3 memory makers finishing their own new clean rooms, plus HBM yields eventually improving and freeing up wasted wafers, plus any potential slowdown in hyperscaler spending.
And suddenly, the farmer's market is flooded with corn again. So CXMT is less a new HBM rival right now, and much more the bear market's Exhibit A, that memory could absolutely become a brutal cycle again in a few years.
Before we move on to the rest of the market, we have to talk about how people get hurt even when they are right. The traders in Korea and Taiwan were absolutely right that AI and memory demand is real. The fundamentals back them up. Yet, extreme leverage and oversized portfolio concentration forced those investors to liquidate before the thesis could prove itself.
We saw it with the margin calls in Korea and the record crash in Taiwan. I say this kindly as a reminder of how markets work. Diversify for real. Avoid using borrowed money where you can. Size your positions so that you can emotionally and financially survive a 20 to 30% air pocket. You have to keep enough cash to outlast the volatility, because being right on the thesis is not enough if you cannot survive the margin call to see it play out.
When the chips were falling, the money had to go somewhere, and where it hid was fascinating. The software ETF, IGV, actually rose 0.42% for the week. Compare that to the SOXX being down 10.24%.
Apple was the major standout in the mega cap space. It was up 5.84% for the week, pushing to record highs after China cleared Apple Intelligence for use. The market loves Apple right now because it is capital light. They sell a finished consumer product, not merchant silicon.
We did see some red in big tech, but the context matters. IBM dropped recently, but that was about mainframe cycles and capex timing, not their software business, which actually grew 5%. Alphabet fell about 2.5% on the week following reports of a Gemini delay.
And Microsoft experienced selling pressure, but it was largely treated as a high-duration AI capex payer. The market is trying to figure out who is spending the billions and who is actually collecting them.
We also learned this week that when expectations are sky high, even a good print is not good enough. Look at Netflix. The stock fell 7.3%. They delivered a narrow EPS beat, but had a slight revenue miss and narrowed their full-year guide. The market had zero tolerance for slight.
Intuitive Surgical suffered a similar fate. The stock fell 14%. This is a company that posted 19% revenue growth, hitting $2.89 billion, with surgical procedures up 16%.
But the street zeroed in on decelerating growth rates and a very rich valuation. It is a classic environment where great companies get punished if their stock prices have already priced in perfection.
Shifting to the macro picture, we actually got two calming data points that suggest the economy is holding together. The University of Michigan Consumer Sentiment Index jumped to 54.4. That is a 5-month high, up from 49.5 previously, driven mostly by easing gas prices at the pump. Though we should note that one-year inflation expectations are still elevated at 4.2%.
We also saw housing permits slip 3% to about 1.367 million, while import prices rose a modest 0.3%. But the really important macro signal is under the hood in the plumbing of the financial system.
Exactly. Federal Reserve Bank reserves actually rose about $43.8 billion on the week, sitting comfortably at $3.143 trillion, while the Treasury General account drew down. This means system liquidity stayed highly supportive all week. What we witnessed in tech was a positioning and leverage crash, not a systemic liquidity drain crash. The real watch item on this front will be the late July Treasury account rebuild.
While the financial markets debated chip cycles, a massive geopolitical development in AI governance took place. At China's World AI Conference in Shanghai, President Xi Jinping delivered a keynote calling for a UN-centered model of global AI governance.
The framework he outlined focused on open source and shared development, strong human control and safety standards, respect for cultural diversity, and specifically helping the global south close the AI compute divide. He also criticized what he called overstretching national security, which was a clear reference to Western export controls on advanced chips.
The concrete result of the conference was the founding of a new body, the World AI Cooperation Organization. It was launched by 29 countries. Notably absent from the founding members were the US, the EU, Japan, and South Korea.
China also made specific, concrete commitments. They promised 5,000 AI training opportunities for developing countries over the next 5 years, the establishment of joint AI centers with groups like ASEAN and the BRICS nations, and the deployment of a new weather warning AI system to 30 countries.
That weather system is called Meizu. It is named after the sea goddess revered across Fujian and Taiwan, known as the protector of sailors and coastal communities. It is a deeply culturally fitting name for a system meant to warn seafaring families about incoming storms.
We have to look at this even-handedly. On one level, it is a genuine capacity-building effort for developing nations that feel left behind in the compute arms race. On another level, it is a brilliant strategic move by China to shape global AI standards outside the Western sphere. As UN Secretary-General Guterres noted in his own remarks, the need for inclusive governance is real, and the geopolitical table is officially getting much bigger.
So let us pull all of this together and tie off the narrative thread of the week. We have two honest, competing stories about semiconductors right now, and we need to steelman both sides.
Here is the bull case. Supply is genuinely, structurally short heading into 2027 and 2028. This cycle is different because the long-term contracts and the customer co-funding arrangements are much more durable than anything we have seen in past cycles. The drop we saw this week was largely a leverage purge combined with a narrative swing. It was not actual proof that underlying AI demand has collapsed.
But here's the bear case. There is a massive double supply wave coming in 2027 and 2028. You have CXMT ramping up. You have the incumbents bringing new clean rooms online. You have HBM yields improving, which frees up wasted wafers. And you have the ever-present risk of slowing hyperscaler capex. That combination could easily bring back falling prices and cratering utilization. Today's earnings sit on a conventional price windfall that simply may not last.
Giving you our honest lean. In the near term, the shortage looks incredibly real, and the core demand thesis remains intact. The physics of wafer production support the bulls right now. But we say plainly, we could be wrong.
And here are the specific tells we are watching to see if we are wrong. First, whether the leverage finishes washing out of the Asian markets. Second, the timeline of that 2027 and 2028 supply wave. Third, Micron's September earnings. We want to see their HBM booking horizon, their conventional pricing, and any commentary on CXMT. And finally, whether the hyperscalers can actually prove real financial returns on their massive capex spending. This is just our reasoning. It is not gospel. You have to decide which story you believe.
And you will get a lot of data to help you decide very soon, because we are heading straight into an earnings gauntlet. Monday kicks off with a few leading indicators, but Wednesday the 22nd is huge. We hear from Alphabet, Tesla, ServiceNow, GE Vernova, IBM, and NextEra.
Then Thursday the 23rd brings Intel, Freeport-McMoRan, Cleveland-Cliffs, SAP, and Newmont. Friday the 24th, we get crucial macro data with the flash PMIs, durable goods, and new home sales.
And just to look slightly over the horizon, the following week, starting the 29th, is the real heavyweight fight. Microsoft, Meta, Lam Research, Vertiv, and Qualcomm. The verdict on capex versus actual returns starts right now.
So, what did we learn this week? AI demand was real all week. The trade still broke anyway. And on Friday, the chips finally started hunting for a floor.
But as we have discussed, the deeper question, cycle or secular, is the one that will govern this market for the next 2 years. We gave you our lens and we walked you through our reasoning, but the watching and the final judgment is yours.
Survive to be right, manage your risk, and always do your own research. We will see you next week.
That's a wrap. If this was useful, follow or subscribe for the next one, and tell us where we're wrong. Thanks for listening.